Welcome to Stockwatch with me, Ndawuleng Lechela, and joining me to unpack your stock-related questions today are Ricus Reeders from PSG Hole in Ruimsig and Shane Watkins from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag Stockwatch. Gents, thanks so much for joining me today. Let's start off with your reading on markets action. All eyes are on Washington this week with that July 9th deadline around the corner. Overnight, though, we've had, quite a lot of talk from the Trump administration. We have Trump threatening additional tariffs on nations aligned with BRICS. There's also talk of reciprocal tariffs coming into effect from the 1st of August if deals aren't sealed. What does this mean? Does it mean that they've shifted the deadline, Shane?
Darling, I think, Trump has shifted the deadline 2 or 3 times now.
Yeah.
And I think that, of course, Trump uses the media as a medium of negotiation.
Mm-hmm.
And so I think our base case is still that, in general, tariff rates will be agreed, although it obviously is a tail risk and a slightly greater tail risk for emerging markets, of which South Africa is 3% of that index.
Mm-hmm.
So I think it certainly is a risk. And, it's a very unpredictable environment. If there was to be a negative impact, it would certainly be felt to a greater degree in emerging markets, particularly given Trump's comments on the BRICS countries.
Yeah. And just your take then, Ricus, are we seeing markets shrugging all the risk off? Yes, trade quite choppy today, but over the past few weeks, we've seen markets, hit record highs.
Yeah, I think there's 2 facets to that, as Shane has said, with Trump moving deadlines and using the media as negotiation and threatening and then not threatening and contributing to uncertainty. I think markets or traders in general are getting desensitized towards what he does. So they just wait for him to do what he's going to do. In the meantime, companies and traders and investors are finding workarounds around that. If you consider the impact these announcements from Trump had at the start of the year, or at least since April, and now you can see markets are starting to shrug it off. The second aspect to that is that because the volatility that started in April with the first announcement of tariffs is working its way out of the market.
Yeah.
As I said on Friday myself, and I think a lot of other fund managers were probably hedged too much against volatility, which didn't transpire over the past 3 months. So people are too liquid, and by default they have to chase shares. And added to that is US companies buying back their own shares because they don't want to invest in their operations. Times are just too uncertain. That also adds to upward price momentum.
Okay, that's interesting. That's really interesting, Ricus. And just on trade deals then, Shane, there's a question here on Adidas and Nike. The viewer asking whether your sentiment has changed on the counters following the US-Vietnam deal. Of course, these 2 counters have manufacturing hubs in Vietnam.
And darling, so I guess there are stock-specific issues and then more generalized geopolitical issues that affect these companies.
Yeah.
What happened to Nike is that Nike previously used, let's say up until 5 years ago, they distributed the majority of their product through agents, like, say, JB Sports or Dick's Sporting Locker and so on. They then went on a campaign to disintermediate their distributors by selling direct to consumers online. And that antagonized their distributors. And at the same time, there were a whole lot of new footwear offerings that were slightly more interesting and innovative coming out. So having abandoned their normal distribution channel and facing greater competition, Nike was severely impacted. I mean, the share price fell from above $100 to, I think it got down to 55 at one point. It has rebounded slightly. So Nike has some specific issues that are related not just to the tariff wars. Having said that, over 90% of their product is manufactured in the East, and if there are tariffs, it will affect them. But remember, on footwear and apparel, the markup that retailers put on it is at least 100%. So even if you were to slap a 10 or 20% tariff on the cost, the landed cost in the United States, that would only be a 5 or 10% extra cost to the actual consumer because the markups are so high by these retailers. So I think it's certainly the tariffs are negative, but they're not that material. And I think particularly in the case of Nike, the problems are more related to the negative strategic interventions of previous management. Now, a new management team has been appointed, and they're kind of going back to their old strategy of selling their product through distributors. And I guess you've got to say, Nike is a fabulous brand, and in time they will recover.
Okay. All right. Ricus, I'll give you another question. A viewer asking why we are seeing, oh, I just lost it. But it was around HCI. I don't know if it's a counter you look at. Yes, got it. Could the panel explain the 10% increase in HCI's share price?
Well, they announced a very convoluted deal with their shareholders, specifically their union shareholders, and where HCI, as I understand it, is basically selling off some of its properties in order to make up for losses suffered by the union as a result of the drop in HCI's share price. It's difficult for me to put a value on that transaction in that how much does it actually better the position of the company rather than the unions. It might look like a clever way of refunding everybody, as I said, selling these properties at whatever price, but whether that's an opportune time to sell it and whether you're getting fair value for those properties just because you're trying to make a loss up somewhere else, I'm not sure really affects the standing of HCI, which is in effect just a holding company of which its major assets are in gaming, and specifically physical gaming, and that's not a very good place to be in at the moment. So I think the price increase is mainly surrounding the corporate action, and yeah, I can't say how it puts HCI as a holding company in that much better a place.
And Shane, I see.
Tali, maybe if I can add to what Ricus has said there. So the largest shareholder in HCI is Union Sakawu, and they have had cash flow needs, and they have been continuously selling down their stake in HCI. Their stake in HCI at the moment is a little bit under 30%. And as a result of this transaction, their stake will fall to about 18%. But I think the main point is that because the union is now getting liquid assets in, that will relieve them of the need to be continuously drip selling HCI shares into the market.
Okay.
And so I think the reason that the market likes this is not so much that there's a favorable impact on the financial situation of HCI, but more that the main seller of HCI is now probably not going to be selling shares, at least for the foreseeable future.
Okay. All right. Thanks for that, gents. A question here on Rainet, excuse me. Can the panel explain why Rainet accepted a price for its share in PIC that was in fact 20% below its own valuation? Its asset value has now dropped approximately 6% relative to its latest figures. They will have to shoot the lights out to make up for this, have done nothing yet with BAT. It seems Rupert has lost his mojo. What do you have to say to that, Shane? Let's start with you.
Okay, so they sold their stake in Pension Investment Corp at below carrying value. I think that is true.
Yeah.
And I think everyone viewed the stake in Pension Investment Corp as being an extremely good asset because management of Pension Corp had articulated at least a 10-year runway for them to continue roll out the change in the, taking advantage of the change in the pension environment in the UK, where funds are converting from defined benefit to defined contribution funds. I have to really agree with the listener's question, because it's very hard to see why they sold this asset. Now remember, Rainet had three assets. They had some private equity assets, which is small, about 20% of the fund. They had their shares in British American Tobacco, and they had their shares in Pension Corp. About 6 months ago, they sold their shares in British American Tobacco, and this month they sold their shares in Pension Corp. So 80% of the assets of Rainet now are basically cash, right? The Rainet NAV is 760 Rand. 610 Rand of that is cash, and the share's trading at 529. So it's trading at about a 13% discount to the cash it owns, plus you get the private equity assets for free, or you can say it's trading at a 30% discount to its NAV. I think the main point is that it is extremely cheap, and the thing that is difficult to put a handle on is what will they do next? Because clearly if they were just to unbundle the cash, then there'd be a huge uplift in value.
All right,
if they were to buy back shares, there would be a huge uplift in value. But the thing is that no one knows, and it's one of those companies that is listed on the JSE where there is just no transparency. No one has any idea what they might do here. And, you know, the viewer is right. It is difficult to understand why they sold Pension Corp, and it is impossible to know what they may do from here. Having said all of that, I think it's very evident from the way I've articulated how the NAV is made up, that it's extremely cheap, and you shouldn't really have such a large discount to a company whose major asset is cash. So we think almost anything they do from here will unlock value, but it's hard to know because it's impossible to understand why they sold Pension Corp.
Question here on the banking sector. I'll start with you, Ricus, and basically the viewer asking for your thoughts around Absa. It's been quite, you know, the cheap one in that industry.
Yeah, not only me, but a lot of people will say that Absa offers good value in that sector, and the sector itself is possibly also offering good value. Absa, because of basically of the recovery in their operational efficiencies. It's been a long time building, so just on that basis, on a pure valuation basis, it gives you upside. That being said, the banking sector in whole, price momentum at the moment is sort of neutral to negative. Not quite sure why. But as I said, yeah, on a fundamental valuation basis, Absa offers value. I'm still in doubt whether I would include it in my portfolio, because even if it does catch up to a realistic value, let's say you're still sitting with a banking operation that's not the best of breed in my view, and if I invest for somebody or for myself, I'd like to have a company that's not only undervalued but also operationally very efficient.
So which bank would you then pick in the sector?
Your sort of normal South African banking operation, First Rand.
Okay.
Otherwise, Capitec, although very dearly priced at any kind of normal valuation you would have, just because of the shift in their sources of revenue and income growth. I'm comparing Capitec more to the likes of Visa, where it's becoming a transactional platform rather than a pure banking operation.
All right, then, Shane, which bank would you pick? Maybe let's start off with your views around Absa, if you're liking that.
So Absa and Nedbank are the two cheapest banks in South Africa. They both trade at book value or a little bit less than book value. Book value on a bank more or less means that if we were to liquidate the bank and pay nothing for the brand or the systems or the processes, how much money would you get back? and both of them are around book value or a little bit less. So in general, my experience in banks is that if you acquire a bank at less than book value, and the bank is not in financial difficulty and you are patient, you will make money. You can go back and have a look at 30 or 40 years of data. If you have bought South African banks below book value and you're patient, you make money. Now, both ABSA and Nedbank have got new chief executives. Kenny Fila has taken over at ABSA and Jason Quinn has taken over at Nedbank. I think it's right that Ricus said that neither of them are the best managed banks.
Yeah.
But I think both Kenny and Jason are good appointments. And I think there are some easy wins for both of them in getting both of those banks to operate more effectively and more efficiently. So I actually think that both Nedbank and ABSA are good opportunities here because of the new leadership.
Yeah.
But I would also say that banks in general, they like a low bond yield and they like a strong rand. And provided we see that the SA 10-year doesn't sell off much above 10%, and provided the rand stays below 18, then you're going to be fine. But banks are kind of geared plays to conditions in fixed income and the currency. And, you know, if we have any wobbles in the trade war with Trump, if that is how it eventuates, then banks will sell off aggressively. But for the moment, I think they're both good investment opportunities.
And, you know, the talk around a lower inflation target then, Shane, is that also giving banks a boost at this point?
Yes, I think so. I mean, I think that, you know, if you see the 10-year yield come down, that will be good for banks. And the way that the 10-year yield can come down is if they lower the inflation target, because lowering the inflation target means that we're going to have higher short-term rates and lower long-term rates. And that shape in the yield curve is good for banks.
Okay, let's move over to the mining sector. Ricus, a viewer asking if it's not too late to get into gold miners at these levels.
Well, the big caveat there is obviously that the gold price maintains current levels, which I think it can be considering the flow of country banks, you know, country's reserve banks, if we call it that, into the physical asset itself. We can have a discussion about that as far as the increasing role it's playing in their reserves and for the various reasons, but I don't think the gold price is under a huge threat at the moment. But remember, it will remain volatile, and gold mining companies even more so. But to answer the question, I don't think it's too late to be in gold mining companies, providing that the gold price stays at reasonable levels, you know, where it is now. Yeah, I think if there's any weakness, it's more of a buying opportunity than
anything.
Than running away from it.
And I was about to say that dips we've seen in gold prices haven't been significant. So it could be presenting a buying opportunity, right, Sean? Shane?
So, darling, yeah, I think the fundamental underpinnings of the gold market, which is essentially central bank buying, are not going away. I think the geopolitical changes that have been happening over the last decade and which have accelerated under the recent Trump administration are not going away. We have seen buying by the Chinese central bank, the Indian central bank, the Saudi central bank, the Brazilian central bank. That buying is not going away. I think the other thing to add is that if you look at precious metals in South Africa and globally, in PGMs, there are essentially only 4 companies in the world that you can buy. In the gold mining sector, there are basically only 10 or 12 large gold mines you can buy. I mean, bear in mind that there are 50,000 listed equities in the world. So if you want to access precious metals, there's less than 20 companies that you can buy of any decent size.
And that brings me to the next question, because a viewer here asking if you are seeing opportunity in the PGM players. We've had many questions coming through on Valterra as we see, you know, that surge in platinum prices. Shane?
So we're very positive on Valterra. Remember, Valterra is the old Anglo-Plats. It was unbundled out of Anglo-American. Anglo-American still own 20%, but it's essentially an 80% free float company. And I think ultimately Anglos will unbundle the other 20, and then it will become 100% free float. And to the extent that companies become a greater free float, then their weighting in the indices goes up, because indices are free float adjusted. So we've seen a lot of passive buying for these companies. Valterra is the largest platinum company in the world. It has the best assets, and it is quite well managed. You know, platinum is an 8 million ounce a year market, roughly. A large portion of that has gone into auto catalysts, and in the past, a fair amount had gone into jewelry. Less than 2 million ounces per annum. But in the last month, we have seen 400,000 ounces alone be bought in China for investment in jewelry demand. So, you know, it's a small market, 8 million ounces. And if the Chinese start to switch more of their consumption of jewelry out of gold into platinum, and remember, the gold price is 3,500 ounces, the platinum price is a third of that. And so there's quite a lot of incentive for the jewelers to prefer people wanting platinum jewelry rather than gold. It's very onerous on jewelers' working capital, and even large companies like Richemont have spoken about this.
Yeah.
Gold jewelry has become a very working capital intensive business because of the move in the gold price. And so the jewelers are trying to get people to switch into platinum. And if they're even half successful, then it will tighten up the platinum market fundamentals enormously. And then we could see a continued run in the platinum shares. I mean, remember, the gold price is double the platinum price now, but the platinum price used to be 50% higher than the gold price.
All right, gents, we are running out of time, so I will get into your stock picks. Ricus, let's start with you.
It's NXP Semiconductors, which is a Dutch company, which is the first positive because it's not in America. They have a niche advantage in semiconductors in that they don't really compete with the likes of NVIDIA and the really advanced microchips, because theirs is used first of all in the car sector, and where they use their chips in things like radar and LiDAR, which again doesn't compete with those high-edge NVIDIA kind of chips, which is in the which is for the driving part of things. And then secondly, they've got an industrial component where again their chips are specifically used in factories where there's huge where they've got to be very robust as far as temperature is concerned, the working environment is concerned. So they're not necessarily high end, but they are built to last, where they, as I said, have a niche. And with that whole sector being quite positive at the moment, I think that's the added benefit you get from them, because they have those specific modes in place.
And Shane, where are you seeing opportunity at the moment?
I'm telling Ricus has gone with a large global company. I'm going to go with a small local company. My stock pick is Astral. They are a chicken producer. The South African chicken market is called 20 million chickens a week. They produce about 5 million chickens a week. One of their large competitors, Daybreak, is essentially gone out of business. Feed prices, which is 60% of the cost of a chicken, are well under control. The selling price of what we call IQF, individual quick frozen chicken, is up 20% over the last 12 months. And this business is on about an 8 or a 9 PE. It's a simple business with exceptionally good management, and I think strategically well placed at the moment. Alrighty,
so Shane going with Astral Foods and Ricus NXP Semiconductors, and that's where we leave it today. Thanks to our guests, Ricus Reeders from PSG Hole in Ruimsig and Shane Watkins from All Weather Capital. Up next, it's The Close. Stay watching.